take no loss. Hit the ground, then it go off. Yeah, hit the ground, then it go off. Yeah, yeah, run it. Ooh, I really feel it's my time, think it's my year. Yeah.
What is up, everybody? Big morning here on Stock Market Media and the Morning Show. Welcome. We just seconds ago had the May CPI report come out. Looks like it came in a little bit below estimates. We'll talk about that in about 10 or 15 minutes with our first guest of the day, John Netto, author of the Global Macro Edge. Well, John Gagliardi from Fidelity on at 9, Kimmy Sokoloff, Ian Culley. So a big show. 4 guests today, a lot going on. I see you in the chat. What up, Ken? How we doing? Everyone watching on YouTube, drop us a like. If you're watching on Twitter, then head on over to YouTube and drop us a like there. We'd appreciate that. I've got Strazza. I've got JC. I've got my intro. Let's go.
CPI coming in a little cool on a Tuesday morning. Who could have guessed?
Is that the situation? CPI is coming in a little cool, so that means lower interest rates. Is that what you're?
I'm just looking at the headline numbers. Actual 0.1, expecting 0.2, and it came in 10 basis points below expectations on a year-over-year basis as well.
Dude, I'm stoked to ask Netto about what he thinks in the current dynamic. I mean, one of the biggest questions that we find ourselves asking again and again is, this strength that we continue, the resiliency in growth and tech. What is that saying for rates? Like, what is the stock market saying, and what we're seeing in commodities too, for that matter? What is that saying for rates? It's just a fascinating thought. Stocks continue to do well. For me, I think it's because rates have kind of done nothing, and they've just been bouncing around playing ping pong since fourth quarter last year, and stocks really like that lack of volatility in the bond market. They certainly don't like high volatility in the bond market, as they showed in the first half of last year, if you recall, as bonds got absolutely slaughtered. So it's really interesting. So curious to see what he has to say. So for those of you guys don't know, John Netto, our new secret weapon, right? It's kind of like how I look at it. He's our secret weapon. No, wouldn't you, right, Spencer? No,
I would say so. This guy has made a living trading economic data, and also just interpreting it. So he'll come on. I'm sure he's like neck deep right now in the S&P futures. So
I know for a fact.
So we'll let him breathe for a second, and then he'll come on and tell us about it. But sure. Should we do state of the markets first?
I think we should.
All right.
All right. So, I hate to kind of keep harping on, the sector rotation and breadth, but, I think it needs to be front and center this week. As a matter of fact, Mr. Strazza, how time flies. It has been exactly a year since the new 52-week lows list peaked. How about that? This week marks a year.
Happy anniversary, Bulls. You deserve it.
Happy anniversary, Bulls. I mean, I think this tells like a really interesting story. You got tech, discretionaries, industrials, communications on a cap-weighted basis, all up over 20%. Tech up almost 40%. Monster numbers out of tech. Even financials and healthcare up 10%. And then some of the more defensive areas rounding out the end of that, which is perfectly normal, right? Industry, some of the more offensive sectors leading the way in the bull market, and some of the more low volatility, quote unquote, more defensive areas underperforming, right? High beta doing well, very well, as a matter of fact, particularly compared to low volatility. All of these things are just perfectly normal characteristics that we've seen in bull markets going back forever, right? Not just this one. By the way, you like my Avalon, my Princeton? It's one of like the bougie bars here, Strazza. You would like it. Seafood. It's a good party at night. Rocking my beach gear. I'm at the beach for the week. For those wondering where JC is, that's why I have this sort of beach. You like the sign? Ride the wave. I didn't do that on purpose. I swear. I think it's just a nice coincidence.
Just classic beach house.
Classic beach house situation. I really like it a lot. In Miami, we didn't have this sort of thing. This is kind of like a Northeast thing. I'm into it. All right. How about this one, Strazza? Industrials making new all-time highs on an equally weighted basis. All right. So this goes back, to 2006 when the equally weighted industrials index fund was created. It's changed parents a couple of times. It was Guggenheim back in the day.
That's right. Yes, it was.
And then I guess they merged with Invesco or whatever. Now it's Invesco. I don't know. Doesn't matter.
And just a heads up to everybody, you got to update your chart. We got new tickers for these equal weighted ETFs. So RGI is now RSPN.
Is it?
Yeah.
Sick. All right. Fun facts, Strazza. Dropping the heat this morning with the fun facts on the ticker symbol changes. I didn't get that memo. All right.
Oh, I dropped it right in the chat for everybody to see.
All right, beautiful. All right, so industrials on an equally weighted basis making new all-time highs here. Here's the largest component, Raytheon. What's really interesting about industrials, we talk about how diversified of a group they are, and we make even jokes. Like there are certain companies, like I feel like when they don't know what sector to put it in, they just throw it into industrials. Like there's like managerial companies, right? Like employee, like HR companies are like in industrials, right?
Yeah, they call them professional services firms.
There you go. And so then, of course, so you got the railroads and the trucks and like the big engineering companies, right? And the aerospace and defense stocks. Raytheon here is one of those pushing against new all-time highs.
JC, I was saying the other day, because I love playing this game of reorganizing the indexes, shouldn't homies be in industrials? Not discretionary, or is it because it's mostly residential and that's why?
Yeah, right, exactly. It's where consumers spend their income in buying houses. I mean, I'm no expert, but I mean that makes sense to me. Anyway, another interesting fun fact about industrials that even on a cap weighted basis, the largest component is only 4%, which is Raytheon. So it's not like one of these situations like consumer discretionary where it's 25% Amazon, or something like energy, where half of it is Chevron and Exxon, right? Or more than half, I forget last I checked. But, there are certain sectors that are just dominated by one or a couple of companies. Technology, for example, half of it's Apple and Microsoft, right?
Yep.
So the fact that industrials are so diversified from an industry group standpoint and from a component standpoint, it's really interesting, which is probably why it looks exactly like the S&P 500. It kind of looks like the overall market. I look at it almost like a value line index. It's a great indicator as well as a place to look for opportunities, right? So here's Raytheon looking to break out to all-time highs. I'm a buyer on this breakout. Keep going. Look at the Caterpillar and the Honeywell. Those are some big components as well. Basing. Right, within ongoing uptrends, huge bases. These obviously, more when you think industrials. When I think industrials, these are the types of companies that I think about. Right, there's all kinds of other different types of companies, but like these to me are like, bellwethers of the industrial sector, have been for a while. And then if you go to the next chart here, you just posted it, and it caught my attention for sure. The small cap industrials pushing up against new all-time highs. Right.
So when you talk about, breadth, how do I know breadth can't be that bad in industrials? It's because this index is almost making new all-time highs, and it doesn't have that cap-weighted effect that the large cap ETFs do. The largest component in this ETF is Comfort Systems USA at a little bit over 3%. After that, it's Applied Industrial Technologies, 3.07%, and then everything after that is below 3%. So
it's a broad look at those small cap industrials. I mean, not only are we thrilled about it because we've been buying industrials, so obviously no complaints here, but forget our position and tucking our book. Just think about it, like what that means for the overall market is sort of what I'm referring to here. So like, yes, we're thrilled, but what else does that mean? I think it means that breadth, as they keep telling you, is not deteriorating. Quite the opposite. We continue to see sector rotation, which is classic characteristic of bull markets, right? All right. And in the last chart I want to show you, this one comes from the Bank of America Fund Manager Survey. Always worth a look if you can get your hands on it. We get it sent to us from Bank of America. I like to take, there's always a few things that stand out. And of course, we can always trust, our friends in the industry to post some of the other things that maybe stood out to them. So it's pretty cool that a lot of people are looking at this. Interesting from a sentiment standpoint, when you look at the positioning, just equities, just super, super underweight these fund managers and super overweight bonds, which is fascinating. I shouldn't say fascinating. I meant to say it makes perfect sense when you look at the commercial hedgers positioning in funds. If you got that one, throw it up. Look at the large speculators, which are essentially hedge funds, and this is a fund manager survey, so it's a similar community. And they still have on one of the most aggressive short positions in S&P 500 futures ever.
Yeah.
You think the Fonz, the chart ninja, can get that up? Let's see how fast. Wow. Yep. Fonz, very fast, my friend. There it is. So here's the large speculators. See, this is live. This is a live show. But we're on point. Shout out to Fonz. Large specs. So these are, it's not just big hedge funds, but think of it like that. As an investor, like that's good enough information. Yes, they're like family offices and some other stuff, but basically think of it like that. Coming off some of the most aggressively short positions ever. And then you look at the fund manager survey, throw that one up one more time. You could really see, how underweight they are of equities. I mean, it all makes sense. So that's one of the cool things about sentiment. That's one of the cool things. One of the difficult things I should say about sentiment is that it's not just one thing. It's not one data point. It's about looking at them collectively. And if they're telling a similar story, if they're singing a similar song, right, that's good. That's good data.
We talked yesterday a little bit about how it's really only worth paying attention to sentiment when it's at extremes. If you go back to that last chart with the spec positioning, this is what we're talking about when we say pay attention at extremes, right?
Yeah, and we talk about how reliable the COT, right, the Commitment of Traders reports. This is a report put out by the CFTC. If you're trading futures, you have to disclose who you are. Are you are you a buy-side shop? Are you just a retail investor? Are you a commercial hedger? In other words, are you a corn farmer? And that's why you're shorting all this corn to hedge your, whatever, right? You have to disclose who you are. So they disclose that to the public. Most people ignore it. We find it very useful. we put up a matrix. Fonz, actually, if you could throw up the matrix, that'd be cool to show people sort of what we do. It doesn't have to be the latest one. One of the more recent ones.
COT table.
What's that?
Yeah, the COT table. Yep.
Yeah. So in more pure futures contracts, here's this, because if you look, dude, it's so bad. If you go to the CFTC's website and you see what they publish, it is 1,000 times worse than you think. It's so bad. It's all over the place. So, we obviously organize it nice and clean, so we actually understand what the hell's going on. Take a look at it. If you guys have a second, you know what we should do, Strazza? We should post what the actual, where the information is, so you can see what it looks like before, and then what it looks like afterwards. It's night and day. It's really disappointing that the government makes it so difficult for investors to understand what the hell's going on, right? Why do they make it so hard?
What data is worse, in your opinion, in terms of digging through? COT positioning or insider SEC filings?
The SEC filings. You know why? Because at least as much of a shit show that the CFTC report is every week, at least it's a very consistent shit show. So where one thing is, 1 week will be there, right? You know what I mean? As opposed to the SEC filings, which is like one guy in Alabama faxes it in, the congressman in Maryland fat-fingered the apple and sold it and had to disclose it anyway, stupid things like that. While the CFTC, again, as much of a shit show it is, if you can automate it like we have, right? So that's my answer.
You're probably right. They did mess up, though. I'm not going to give them complete credit. They did mess up and not
they got hacked or something?
Yeah, it was some sort of software.
And it took them a month to get their act together. That's really disappointing.
3 or 4 weeks. Yeah, well, I was saying then, I was tweeting then, how do you not have some sort of disaster plan? You don't have this data backed up somewhere. There are companies that can help with this.
How many people do you think are looking at the CFTC report every single week like you and I?
Not many. There are other people out there for sure, because it's great data. And some of us do know about it and use it to our advantage. But it doesn't get looked at enough, probably. I think Ian does a great job.
So hold on. So let me just finish up on that point. So my point was that in the equities market, there's many different ways to participate. You can own stocks, you can own ETFs. Like there's just a lot of different ways that you can position yourself in the stock market. It's not just S&P 500 futures, right? As opposed to something like cocoa or sugar, right? Where there's you got to buy the futures contracts, right? Or short the futures contracts. Like that's how you get exposure there.
I think this is an important point. You're basically saying some of this data is better than other, right? Like the futures markets, if you're looking at the COT positioning for commodities contracts, you're seeing pretty much the entire picture of what goes on in that market. If you're looking at the positioning for S&P 500 futures, you're not looking at the entire picture at all because there's this huge spot market, right? So, and you can say the same about bonds and Bitcoin.
And Bitcoin too, right? Exactly. But to your point about extremes and how when it comes to sentiment, we're really interested in the extremes. And usually it's not an extreme. We're usually middling around, right? So we want to focus on extremes. So as much as it might be less directly informative than something like cocoa, it's hard to ignore just how extreme the positioning is, particularly when you look at something like the fund manager survey and seeing how extreme that is. And you look at some other sentiment data between the advisories and the National Association of Active Investment Manager and the AAII. You add them all up, and it's like, it probably shouldn't be surprising that these other polls and things of that nature are also heavily positioned short. It shouldn't be surprising. It all makes sense, which is why we aggregate it all. Fund Police coming to cut us off on our sentiment talk.
No, not coming to cut you off, but we got Netto here. John Netto, author of the Global Macro Edge, joining us from the West Coast, and he's been trading this number this morning. So let's bring him on the show right now. Mr. Netto, good morning.
Great to be here, Spence. JC.
What's up?
What's up, man?
What are we thinking here?
Yeah, this number, so there's a couple of aspects of this which are worth kind of keeping in mind. The first, this doesn't disrupt the larger bull equity trend. We saw the headline sort of month over month CPI come in at 0.1, a modest miss. We did see, however, the back end, the year over year core number come in at 5.3 versus 5.2. And so that's a definite offset. So when you get this sort of this dislocative data where one thing, one part of it is a little more dovish, the other part's a little more hawkish.
Is it a wash? Does that mean it's a wash?
A little bit of a wash. The challenge is that the core year over year, JC, is a little more problematic. So while this probably gives the Fed a pass tomorrow, and that's what the Fed Fund futures are telling us right now, JC, it does augur for more hikes possibly in July and August, which is why if you look at gold right now, it's actually unch since the release. Fixed income's doing a little bit better, the front of the yield curve, but that's more reflective of the positioning that people are having to square away their bets for tomorrow. So you're seeing a little bit of unwind on the front of the yield curve and in particular, but that should come off.
No, hold on. Let's take a step back. Let's take a
Sure.
step back for a second.
Sure.
Go back a week. Talk to me about a week ago, a few days ago, what Fed Fund futures were pricing in through the end of the year and how that's changed.
Sure. So the Fed Fund futures, in terms of what they're priced for the end of the year, is largely unchanged right now from a week ago. However, what has changed, JC, is what the Fed Fund futures are priced in for tomorrow's meeting, which is kind of like a two-team parlay, like a correlated parlay if you do any sports betting out there, where the decision today, because we came in with a 31% chance of the Fed hiking at tomorrow's meeting before today's CPI. That's now down to about a 7% or 8% chance. So that is material for tomorrow's Fed event. However, a lot of people, the consensus is, and we'll see this tonight in my Fed preview that I write up, is that the Fed is still largely expected to make a move in July. And there's nothing that happened today that impacted that move until July. So to your question of what the Fed futures expects by the end of the year, it's largely unchanged because whether they hike in June or hike in July, the markets still expect them to hike one more time. And then maybe that'll ease off maybe by the end of the year. So this today was more of a procedural note in terms of do they hike in the June meeting tomorrow or are they going to wait until July? But there's a lot of feeling out there, and this is being priced in the Fed Funds futures market, that the Fed is going to have to hike one more time, probably in July, because there's a lot of data that has not let up, but they did set a high threshold at the May meeting. So there's a lot going on there, but that's the context.
Hold on, John. How likely, I'm not the resident Fed expert here, far from it, in fact. How likely is it for them to pause and then hike and then start a hike again? Is that likely?
That's the base case, JC. That's exactly it. So they
are likely, right? Is that common in the past?
It's not very common, but the BOC, the Bank of Canada, just came out and did exactly that last week. And so, Powell has reference in his Fed speeches, a deference to, or at least acknowledgement of, not deference, but acknowledgement of the Bank of Canada. And so what we are seeing is that with the Bank of Canada hiking after a pause, that they are looking at sort of a new precedent. That's not very common. However, I would say this:
is it precedent historically in other countries outside the United States, or no either?
It is, but we have to define, because most central banks, as you can appreciate, have many lawyers on their staffs, and so what counts?
Lawyers ruin everything.
Lawyers ruin everything, as someone who knows intimately. So keep this in mind, JC and Steve. When a central bank comes out and hikes what we think is for the last time, their language rarely says, "Okay, we're done, we're moving on." Rarely. In fact, what they tend to do is provide themselves some optionality for future moves. Okay, and even the Fed is notorious for this, of being, they are purposely ambiguous in their language and statements. And so while the markets will price in a last hike, the Fed typically gives themselves some kind of latitude, based on incoming data, based on interest rates, based on geopolitical conditions, etc. So the Fed has held that line the whole time. So while the market has said we think the Fed is done, the Fed has never formally said we're done. And taking one meeting off, remember, this is a Fed that in 2007, when they went on the rate hiking cycle, or even in 2019 when they were on the rate hiking cycle, would hike on a quarterly basis. And they take pauses between meetings and then a hike at that point in time. But so what you're asking conceptually is, it's not very common. In fact, there's very little historical precedent for it. But in terms of waiting between a meeting and then hiking, yes, there's lots of precedent. But in terms of end of a structural hiking period, that's not very common. In fact, that's very rare.
All right, let's talk about execution here. I was really looking forward to this conversation. Not that I'm not in other times, John, but in this time in particular, I was looking forward to asking you about the resiliency that we've seen in growth and technology, and the areas that we should expect to dominate the market and do well in a falling rate environment. And rates have really been, 10-year yield in particular, really been sideways since the fourth quarter, kind of churning. Stocks really seem to like that, but growth stocks really, really, really seem to like that. And they continue relentlessly higher, even when you get like a little bit of a bounce in the 10-year yield. So it's almost like the stock market is like thinking a few steps ahead of, maybe the short-term bond market movement. But, any thoughts on, copper gold ratio as well? Some of the other ratios that we look at pointing to lower interest rates, what the commodities market is doing in general. Can you touch on that? Do you think who's got it right here, and where does this ultimately resolve on the 10s?
10s, I think, honestly, can continue consolidating. I think what we're seeing is bifurcation. And any shallow dip, you got to buy tech for the moment, and you buy tech with structured trades. I think through optionality, you can structure risk things in a risk-defined way, but don't get in front of the AI frenzy. And I'm not qualified to speak to all the dynamics behind it. What I can speak, though, is if you overlay this on other, I'm not going to say bubbles, but let's just say repricings. Okay, let's just call this a regime shift. And the regime shift, at least conceptually, is that we are on the frontier, if you believe the price action, or at least maybe the second or third inning of a paradigm shift of how corporations can make profits, and that is through the displacement of labor, or at least not displacement, but at least reallocation of labor to more profit margin intensive or service sector components through the advent of frontier change and life changing technology, i.e. AI. And so as long as that narrative is in place, there's not much reason to fade it, but like everything, getting good prices and getting at good entry points is a reason. So, like last week, of course, this is like this hindsight nonsense I'm going to try to avoid, but, shallow dips in the NASDAQ, i.e. 200, 300 basis point pullbacks, 400 basis point pullbacks are natural spots, like more shallow support on like a 60-minute chart, have been natural spots to buy. And I think you need to continue buying those spots in risk-defined ways, because, and then we're going to get, as this stuff plays out, and again, I want to stay away from the larger concepts because we want actionable stuff here on Stock Market TV. But the way these things play out,
I like how you did that. I like how you did it. That was good. Look at you.
Well, it's all about the brand. And so when you're looking at that, it's like, okay, how do these cycles work within these markets that are repricing? Whether you believe the narrative or not, whether you believe in the AI story or not, we can learn a lot from the Bitcoin melt up in 2021. Okay, in terms of what the price action was, what is, and here's one thing to keep in mind about repricings. Repricings can go a lot farther than people think when it's really hard to define the value behind it. Okay, so what was problematic about pricing Bitcoin,
particularly when they're coming off such extremes in sentiment, also talk about an unwind.
No doubt, JC. So when people actually begin to get a sense of how to price AI and how to price the metrics behind that, that's actually when you begin to get tops. Okay, it's when the blue sky is not yet definable or totally definable, or it's nebulous in that regard, that the pricing can get a little crazier. Okay, so now let's go back to your question about what interest rates play in this. As long as growth are as long as these companies are putting up multiples of 5x, 8x, 10x, 15x, okay, the Fed being priced at 5.25 or 5.5 is far less consequential. It hits people on the leverage, on the margin side in terms of intraday margin, and we'll get some shakeouts along the way. But right now, the interest rate narrative or what the Fed's going to do is just almost inconsequential for tech. And if it does revert back, that's a liquidity providing opportunity, likely for now to play part of a broader, larger trend to the upside.
How come? But in the do we buy treasury bonds or not conversation, all of this in theory points to buying treasury bonds, but they have dramatically underperformed and diverged relative to growth. When they were moving tick for tick, remember? It was like, oh, these tech stocks are just bond derivatives, right? They're just an extension of the bond market. It's a bond trade. What happened to that?
There's multiple factors at play here. One, remember the Fed is undergoing QT, quantitative tightening, which we'll get more color on tomorrow. Okay. Two, we're dealing with a debt ceiling dynamic.
Quantitative tightening theoretically good for bonds?
Well, depending on what degree that they do it. If they abate the reposition of, remember the Fed has trillions of dollars in bond holdings that they're systematically selling off.
Oh no, I see what you're saying. Yeah. Okay, that's fair. So there's short-term pressure.
Short-term pressure potentially, or less short-term pressure if they adjust. Now, if they speed up the pace of QT, all right, depending on what part of that portfolio they sell. Remember, we're talking about bonds now. We're talking about the long end.
Yeah.
The Fed has 2s, 5s, 10s, 30s, ultras. That they own just the entire spectrum in their portfolio. What part of that portfolio they decide to sell, is a little reminiscent to Operation Twist from 12 years ago when the Fed decided to sell the middle part of the yield curve and let the long end stay. All right, as a way to sort of de facto adjust interest rates, but at the same time keep longer term rates and mortgage rates lower for the way they manage that. So there's a lot of moving parts in the bond market, and what the bond market does over 1 or 2 weeks can be a function of institutional flows, and less about their correlation to tech stocks or the growth phenomenon happening in the technology space.
All right, John, we gotta let you go. John Netto, author of the Global Macro Edge. Thanks a lot, man. Good stuff.
Hey, JC, Spencer, Steve, good seeing you guys as always, man. Peace.
Yep. All right.
Adios. John Netto, the secret weapon.
Yep.
Okay. Let me do this before we bring this guest on, okay? Because this is going to be all the talk today. Breaking news while you were rambling, JC. We had a big insider filing. We'll talk more about it on Hot Corner, but Ryan Cohen is back at the helm at GameStop. He's buying inside.
Wait, hold on. I'm sorry, Steve. Did you say breaking news?
Breaking news. That bumper is too long. Sorry. Oh, that's good. Yeah, if it's breaking, we got to be quick.
No, that was too long.
Shout out to our homies at the Trade Exchange. They get us this data live as it hits the wire. 8:37 today. We got a Form 4 filing. Oh God, Fonz, you're so good. Form 4 filing. Ryan Cohen just purchased $10 million in shares. His updated ownership, because he also had to drop the 13D, which also came in right around the same exact time. 12% ownership interest. And remember, we saw this coming yesterday or the day before. We had 2 GameStop directors buy a little bit. Didn't we talk about it on here? About $300,000. Front running Ryan, who just bought 10 million. Stock is up big, and it's been up big for the past few sessions now. We'll go over the chart later, but I know we got an interview to get into. I just wanted to get this out there because it's about 20 minutes old.
Yep. Appreciate that. Yeah. Ryan Cohen, the new executive chairman of GameStop.
Yeah. The pump is going to be on again. Just it's very much coming. I'm surprised the stock is not up more. But this is what GameStop shareholders are waiting for.
I just don't know how this is even still a thing.
It's still a thing, dude. He's gonna do it again now. It's really incredible.
This is ridiculous.
SEC's got their hands full going after Coinbase, I guess. Guys like this just running wild out here. But sure, okay.
And they just keep issuing secondaries and shit like that. It's crazy.
You know what?
I don't know the last time they've actually done that.
Did AMC do the secondary?
I don't think they've done that for a while.
Just look at how well the stock has held its gains from like the 2020 lows. That's what's really incredible. This is like a mid-cap stock.
People ask me, I'm like, it's just not my game. Like, I don't know what to do with this. What do you want from me? Like, there's so much other cleaner shit out there. It's not for me. But if you're like day trading and stuff like that, there's action in there. So who cares, right? So it really depends on who you are as an investor, and that's just not my game. And the day trading that I do is with Kimmy, and she never talks about any of those stocks. She's talking about Alibaba. I've never seen anybody talk more about Alibaba than Kimmy. It's pretty funny.
All right, let's bring on today's featured guest, Mr. John Gagliardi, regional brokerage consultant at Fidelity. And he's here right now, so let's
can't
get
wait
him.
to ask him about GameStop.
Come on now.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
What's up, John?
Good to see you guys.
Likewise. I like the.
By the way, the segues on the show where you drop the bomb on it, man, that is awesome.
Wait,
Not
John,
bad, right?
John, is it possible to flip your camera again to go to the video there and just flip it around? So
You're more handsome flipped around. You know that, John?
We need backgrounds like John, right? This is nice. Does this pass?
John, what do you got back there? You got your trophies back there from 7th grade? What is that? What do you got back there in that thing?
Actually, my technical analysis books, a lot of my favorites in here.
Oh, I got the same.
Reminiscent of the stock operator. I got all the goodies.
Hold on. You have time to read books with 4 kids, you maniac?
I used to. That's why they're in the showcase. Collecting dust.
Shout some of your favorites out for the viewers. Reminiscences. What else? What's on the top of your list?
Believe it or not, The Science of Cycles and everything the guy wrote after. It's the first book is 90% nonsense, but the 10% of gold that's in there is worth digging for. And we're going to talk about it today. 5-year business cycle. It's all over the place. It's still what I do every day.
All right. We were asked about stage analysis yesterday.
Yeah. So John Gagliardi, I mean, I feel like I've seen you so many places over so many years. You always pop up, right? You're consistent, man. You do great work. Obviously we're like, all right, we got a new morning show. We got to have you on. You're like, of course, anytime. So I want to throw it out to you, right? We talk too much as it is. So what's on your mind? Like, how are you approaching this market? What are you seeing?
So today I put together some charts on the S&P, the NASDAQ, and small caps. And I'm looking at things a little different. I know you guys. I listen to you guys. I'm a huge fan. So I figured I'd hit this at a little bit of a different angle. So here's the S&P. And if you notice, I put that stabbing line there through the first fake out that the S&P gave us back in August of last year. It looked like it was breaking out. It looked like we were having yet a third V reversal, and then it fell apart on us. So the second line I have stabbing through is just last week. So this is all like still in the making, still in the happening. So if we look at the S&P, I look at relative strength different. And the way I look at relative strength is it goes into zones. So the green zone there, you can see clearly S&P is up, relative strength agrees the whole way through. And then it starts to give us lower highs at the end there. And sure enough, it falls apart. And then we get into this red zone. And the red zone is the downtrend. And then we shifted gears again. It's subtle. When you go sideways, it does become subtle on relative strength. You were no longer dropping to 30. You were dropping to 50, 45. And then rallying to 58. And he did.
John, sorry, you're specifically referring to the relative strength index, RSI, correct?
I love this, John, because something we do internally is we'll identify a bullish momentum regime and a bearish momentum regime, which would be what you have in green and red here. But now you're basically saying there's like a sideways or a neutral momentum regime during a basing pattern, which makes sense, right?
He's making us look bad. He's one-upping us, Strazza.
Well, the thing, it's expansion, peak, recession, trough every 5 years. And that's the things that perplex investors. And the more difficult thing is a lot of these trends overlap. If you look at the downtrend and you drew a line, it would overlap the sideways move that we've got started. And if you, so look at this that red line that I drew through the whole chart. The fake out in August, if you were looking at relative strength, you would have said, I got a higher high by about 4%. Relative strength doesn't care. It's giving me an equal high. But MACD agrees. So if you're not using all the tools in your toolbox, you may have had a couple of tools that agreed with you, and you might have plunked your money down, and you're waiting like another 7 months, 8 months to get back to break even. And better to use all your tools. Using more tools takes a little more time. It's a lot cheaper than plunking your money.
No, I like how you sort of incorporate a weight of the evidence within momentum characteristics, right? I think that's really informative for sure. I like that a lot. All right, what else we got on the itinerary? What else are you looking at?
Hold on, let me ask one follow-up on this quick, because I think this is important. The S&P hasn't been overbought for a long time, I think since like last August or last fall, right? We are making new 52-week highs today, taking out this key level at the August highs. It's also the 62% retracement. If we get an overbought momentum reading, is that something you would look at and say, okay, that's really confirmation for these new highs, confirmation for this breakout above the August highs? Is that what you're looking for? Because I think we're getting it today.
Didn't SPY get overbought yesterday? Got overbought yesterday.
Yeah, I'm looking at the index though. Yeah.
Yeah, so what's overbought can remain overbought. What's different this time in this breakout that's different than August? Relative strength is higher. It's not equal. You got a higher high in relative strength, higher than all the highs to the left going back like a year. And also MACD is now above the 0 line and it's fanning itself out. So it looks a heck of a lot more bullish than the August high, yet they're the same price. Everything else is different other than the price. And that to me is key. And if I had it originally, I drew a little line from that sideways chop that we were in at 4,200 to this rally to 4,300. It's the same 4% move that we saw back in August that I did highlight. It's the same move, but everything else is different. Relative strength higher, MACD higher. It looks like we have a lot more.
Ashley asked the question: is overbought is 70 on RSI? Yup, overbought 70, oversold is 30. And by the way, the Qs have been getting overbought since last month. So John made a good point. Something that gets overbought can stay overbought. The Qs have been consistently getting overbought since last month. And what I like to say when people are like, "Whoa, JC, I can't, we can't buy that stock. It's overbought." Right? You get that a lot. It's like, how can an overwhelming amount of buying pressure possibly be a bad thing?
So let's just clarify for those trying to follow at home. This is a weekly chart, though. A lot of time we're referencing the daily RSI 14. What we're looking at here is a weekly RSI 14. Is that right, John?
Correct. And the reason I do that, there's a reason I do everything. So The Science of Cycles, that book behind me, the author becomes obsessed with cycles. So if you read his life story, it's kind of like reading the story of a mad scientist. Cycles were like the precursor to technical analysis. And the author was hired by Herbert Hoover in the Great Depression. And he said, is this normal? Should we expect a 1929 every 10 or 20 or 30 years, as some people are suggesting? And he did the science behind it. And he said, maybe there are these 50-year cycles and 5-year cycles. And that was the gold inside the book. And what they found was every 5 years, there's a business cycle. Now, this guy came up with data that no one was looking at. He did airline commercial air miles, and he did them on a logarithmic scale, so he could actually see and sure enough, every 5 years there was a business cycle, an expansion, peak, recession, trough. And yeah, if you want to bring up the Qs, that's another great 5-year. I put on a 3-year moving average. I challenge you, find another guy that's using 156-week moving average.
I got to tell you something, John. I talk to a lot of people, as you're well aware, and I hear about a lot of moving average. Everybody's got a moving average, but this one is a new one on me.
All right, I'll take it. Getting that stamp of approval from JC saying I got something new.
First of all, no one's approving anything. I'm just saying it's unique. We'll see how good it is. Let's see it. Let me hear your pitch. I'll listen.
Okay, the pitch is if there is a 5-year business cycle. They're not all good years, right? You get about 3 years good, about 2 years bad. Sometimes it's 4 years good, 1 year bad, but on average, since World War II. And Fidelity has this all over our website. We believe there's a 5-year business cycle. We believe that sectors rotate. There's all this stuff inside the Fidelity site that you could read. There's a 9-page article about investing using the 5-year business cycle. And if you look to the left on the 3-year moving average, you get a touch in 2018, the Qs take off. You get a touch in 2020, and that's how you knew the Qs were the strongest of the 3 major indexes. During COVID, of course, we're going to use a lot more technology, and the Qs held up. It's curious that the Qs did fail, and they kind of disrespected that 3-year moving average, but here they are now. Now they're leading. They're way higher on that 3-year moving average than the Russell or some other stuff. But before I leave this chart and before I leave my beloved 3-year moving average, if you look down at the relative strength, the way that we could have seen that tech was going to lead once again, relative strength was giving us higher lows all throughout this, like 3, 4 higher lows on a weekly chart. That's rare. You'll see that on a daily, but to get 3 or 4 higher lows on a weekly chart,
with lower lows
usually by 2, it goes. Yeah, equal lows on price or even lower lows on price, yet relative strength was stubbornly giving us higher lows every time. And MACD just kept on gliding its way up. It was tight, but the slope is up. You know, up is good. And when you have everything agreeing, you have to agree. And by the way, JC, got to give you props. You were on Fox Business News, tell Maria Bartiromo, this is it. June was the low for the NASDAQ, and people are like, are you crazy?
John, you know what I've learned over the years? The more crazy they think I am, the more I'm probably onto something. It's when everybody agrees with me and is like, "Oh, JC's right," and I got, everybody loves me. That I'm probably not onto anything, right? So I've learned that over the years. I've been beat over the head with it. So, I welcome it, just generally email feedback that we get, of course, social media, obviously. It's a good place to go fishing. And for those people who know me, I've been on Twitter for 15 years. I know how this game works. So I throw things out there to get feedback, and I use that as information. So sometimes you're like, why is JC asking such a stupid question? It's like, well, there's a reason why I'm asking a stupid question. And I can use that to my advantage. But yeah, if everybody agrees with me, John, but I appreciate the shout. I'm not sure what you're restricted in, what you're able to talk about and what you're not. What about you personally? I know you work for Fidelity. All good. Are you allowed to talk about how you're investing personally, sort of your outlook, or no?
So this is my outlook, but it is major indexes. So because there's nothing I'm going to say that's going to affect anything. Like I talk about the Russell, nothing's going to happen.
I don't know.
We're
moving markets here on the morning show, right? Best morning show in finance.
You guys might, I don't know. But the last one I have is to show that technicals can be tricky. Just like, hey, August failed, and we never know what's going to happen, right? That August rally in the S&P was a fail, and some of our technicals did betray us, like MACD did betray us. If we look at IWM and we look at the Russell 2000, right now it is more treacherous territory than the other
27.
indexes. It's tough.
Yeah, throw up the Russell chart. We're long. We put on a risk reversal last month. We sold the downside puts. We sold the 155 puts, 190 calls. I believe either the Novembers or the Januaries. If Sean's in here, just ping that. But either way, we were already able to take off the naked puts, and we've got calls that it's a free ride from here, no risk. So it was theoretically an aggressive bet in terms of the execution, putting on a risk reversal, right? Being naked short puts, but we would have unraveled the entire trade October, Sean says. So it's we're in June, so that gives us 4 months still until expiration.
No, you're fine.
So we got plenty of time. We got a free ride. But if at any point the IWM broke below 170, right, started losing that support, all bets would have been off. So in theory, it was a very risky trade. It's literally called a risk reversal. But in practice, there was a very well-defined risk level, which is hilarious because if you remember, fourth quarter of 2018, when the Russell 2000 peaked right at that 169, 170 on the IWM, we were very aggressively short. So these levels are very near and dear to my heart.
Yeah, 170 is my line is your line, right? That's the line. It's crystal clear on a 5-year weekly. And if you notice, I did the same thing again on relative strength, right? You had the buy zone when relative strength was going up. You have the sell zone when relative strength was moving down hard and fast. And so was price. And now we're in a neutral zone, right? We've got higher lows, we've got higher highs, but I wouldn't say it's an uptrend yet, but we're definitely not going down. Something else is happening. But this is one of those trends where nobody knows, right? The real key defining thing, that 3-year moving average of mine, we're below it. And that makes it a tougher sell. If we get above that 185, 190, then the bears are going to have a hard time above 200.
Let me ask you this, John. Right? How do you class, is this in hindsight, you're going back and finding the regimes, or is there a level where you say it's no longer a red regime, it's a yellow regime, or it's no longer a green regime, it's a red regime? Where does that level flip and how?
I'm looking at those multiple highs, multiple lows. So like right now on the NASDAQ and even on the S&P, relative strength is outside that neutral zone, right? It's broken free. Now, will it come back down and hold the lows and create a new regime? Sure, it could. Nobody knows for sure. It's brand new. But this is behind that curve, right? Like this does not look as clean as the NASDAQ, which is the cleanest, or the S&P, which is more clean. This is below trend, so it's a tougher call being in this neutral zone. Because, the tough thing with neutral is this could remain sideways for longer, right? The way that the Fed is running things and the balance sheet of small caps, which has such a big effect on the banks the regionals have such a big effect on small caps. That's really what's making this all come together, right? Like you always say, it's a market of stocks, right? It's not just
people forget, John. People forget. It's a lot of stocks out there, man.
Yeah.
A lot of stocks. I know I spent this year.
Yeah, Ralph Beckham,
We could go on and on forever.
The grandpas of technical analysis.
I know, but we got Kimmy here, so we're gonna let John go. John Gagliardi, regional brokerage consultant at Fidelity. John, it is always a pleasure. We would love to have you back on again.
Thanks, John.
Be here soon, John.
Have a great week.
All right. Kimmy Sokoloff is here. She said in her morning note that she was holding off on any trade ideas until after the CPI print. Well, we are after the CPI print. So let's see what she's watching today. What's up, Kimmy?
Good morning, guys.
Oh, it is a good morning. It's a good morning for us so far. So you said you weren't doing anything until after the CPI print. You got your CPI print. What are you going to tell me? You're not going to do anything until the FOMC?
No. I traded like 8 stocks yesterday. I don't even know what was going on. It was like buy. It just was over and over again yesterday.
And it worked out for you.
Yeah. And then, it just kept going and I couldn't even keep up. I was like, guys, even Mary came on and said I couldn't keep up. I don't know what was going on yesterday. But, for today, I tried to enter. We bought BABA yesterday. We traded it.
Of course you did.
Shocker. Yeah.
It got to move on, but today it's gapping up. So I'm going to watch to see how it handles in here, if it pulls in or not. See how it handles here, and if it could push up towards 88, 81, the 200-day, and push past that or not. So I'm going to let the market subside. We have a big gap up. I might, do some counter trend trade shorts. It's a big gap up today. So we'll see if it's a gap and go or a gap and crap. So I have to watch that really. UPS is waking up a little bit. It's been duddy. A lot of names had moves. So I'm trying to see if there's anything, that maybe could potentially get going, right? We got a nice little flag here in UPS. It's been stuck in this channel, looking to see if it could get a move up towards 173. It's a wide spread this morning, so I can't really tell where it's going to open. Cisco started trigger yesterday. Nice little move yesterday at the 50-30 level. I'm going to watch it in here. This is where it stopped last time. trying to see if it could maybe get movement towards 51.18 or so.
Kimmy, this flag in NVIDIA. I want you to tell me what you're seeing there. Come on.
The flag in the video? Oh, yeah, that
Yeah.
was a total flag in there. But now you have a big gap up. So are they going to keep pushing it towards, push it past 405?
How much is it up pre-market now? It's already up.
Yeah,
it's up every day in pre-market.
It's up like 8 points, So
yeah.
We'll see. We traded MU yesterday. Finally did go after a while, but it took a while. I was like, oh my gosh. We last 11:45 yesterday had a great trade in shop. I recommended it. I was like, hey guys, it's late trade. It was like 11:50 a.m. It was like before I was like gonna sign off. I'm like, shop. I got a trigger around $64. I said, if you have an interest, looks like it could go to like 64.50 and then 65 and then hit a new high, and it did do that. So it was a nice little late day trade for people in the room. A couple of people did take it.
And when you look at semis in general, kind of breaking out of this base, it's tough to fight, man. It's tough to fight, and it's tough to chase, right? Those are the strongest markets.
Yes, it is tough to chase. It is tough to fight. So we'll see. We'll see what we get in the room today. We'll see what's interesting. I'm going to let the market settle. Odds are, they're saying that the Fed won't raise tomorrow. So, we'll see what goes on.
All right.
Nice. Thank you.
Kimmy Sokoloff is live trading the open every single day in her room. If you want to join the room, you can either email us or call us. The email and number are on the screen right now to find out how you can get into Kimmy's room every single day. Kimmy, Good luck today.
Thank you. Have a great day. Bye,
what's nice, having a cup of coffee with Kimmy in the morning. It'll take you half an hour, 45 minutes, have a cup of coffee, put on a few trades, and then go about your day. That's how I look at it.
Yeah.
Can we talk about some real things? We also got long.
Is Alibaba not a real thing?
Anyway, we got long shop.
I told you.
We got long shop yesterday. For those of you who are paying attention, Sean and I talked about it on the Flow show. Both long. Guess what we're in, JC?
What are we in?
I wish Sean could come on here. It's just Sean and I. We're doing a little experiment.
Talk to me about the experiment. Tell the folks.
Weekly calls, pretty much at the money in shop. About the 65s.
And what's the experiment?
See if it works or not.
So isn't that every trade?
I mean, we got 4 days here.
So the experiment is just how short term the trade is?
It's not something we would or Sean would normally do. And it's not even
like it's something you would do.
Not even that short. Not even that
really?
short. I mean, listen, you got to nail the move, right? You got to you got
the price and the time.
You got to buy the breakout and get that automatic reaction, like 2-3 days of follow through, and then take your money and run. So yeah, it looks good right now. We're up about 2% pre-market. We'll see. And we're going to talk about it next week. But if you throw up chart 16 here, I'll tell you why. We were looking through the follow the flow universe yesterday, and we had two options really. Come out and talk about names that we've already written about and been pretty loud about, and that we're already in trades, already long, and kind of on our way to our target already. Or we could have kind of stretched ourselves a little bit and picked some names that maybe we didn't like as much. And I thought, you know what? That's not the right way to do this. Let's focus on the best names, the strongest stocks, and just give like a modified entry, right? So it's just like a follow-up entry in case you miss the base breakout itself, because we talk about it. The best trends and the best stocks are the hardest to get into, right? They broke out from these bases months ago or even quarters ago. They're already hitting target 1 on their way to target 2. And if we're just sitting back only buying new base breakouts, by definition, we're not buying these leaders, right? So I figured let's do a little, do a little exercise about if you're not buying the base, what kind of patterns can we look to identify to get into some of these bases that already broke out months or quarters ago, right? So Shopify, I thought was a great example. You got the base breakout. It checks all of our boxes for a bullish rounding bottom formation. You got the bullish momentum regime. You got the 200-day sloping up, telling us that the trend is now higher on both an absolute and relative basis. That's 2 and 3. And then we took out, critical resistance level at the August highs, retested beautifully earlier this year. and now we're off to the races. I would call this a bull pennant, bull flag. Doesn't matter to me. It's a short-term continuation pattern. The breakout level was 64.50. That's what we were buying yesterday. We were buying this bull flag resolution with a target at 82. You still got 25% upside. That's a nice trade. So I want to know what you think about that, because it's a little bit different from what we typically do.
Well, I think there's a time and a place for everything. In this particular environment, what you were talking about, some of these bases that haven't broken out yet versus some of the ones that have, clearly the ones that have are the leadership groups, right? They're the leaders, and the ones that haven't are the laggards. So if you want to be in the leaders, you know, if you want to own the strongest semis, right? What's the old saying? The only way to guarantee that you own the strongest stocks is to buy the strongest stocks.
Yeah. And you got to be a little bit flexible, right? With these entries, we're not buying these big base breakouts, these reversal patterns. We're now buying continuation patterns, more short-term patterns, but we're very lucky, right? As technicians, we are well equipped with a huge toolbox full of methods that we can use to do this in a responsible fashion, right? So the bull flag breakout, buying the continuation pattern resolutions is a good way to do that, right? You could set your stop at the flag highs or the flag lows. That's up to you. But that's it. I thought that was a good topic to kind of go through.
Yeah, you know, we had a question about Asana. Punch that. It's slide 1 there. Throw that up. You know, this one is one of the ones that has not broken out. So this is Asana. So it's up 6%, up to 24 today. It's a $5 billion software stock.
I just want to add, there was an insider transaction. It was our old friend
Dustin Moskovitz.
Dustin Moskovitz, who bought, it seemed like every month for a year there. Then he stopped for. He's the founder and CEO.
He knows a thing or two about this particular company, I think.
He was a co-founder of Facebook. That's why he's a big deal. He's got a lot.
Yep. He just dropped $3.6 million on about 160,000 shares of Asana.
No, but if he was a co-founder of Facebook, isn't $3.6 million nothing?
Yes.
I disagree with this comment in the chat, Nikki. True diversification is having multiple strategies. No, I think you find one strategy that works for you, that really speaks to you, that you know you do well, and then you trade multiple asset classes with that strategy.
Bullshit. No, he's right.
Nope.
Nikki's right.
No, dude, you just throwing shit at the wall, helium mining, doing trading, day trading options, swing trading. That's not for me. I know what I'm good at, and I'll trade any asset class. If stocks aren't trending, I'll trade commodities.
Just because you don't want to do that doesn't mean that's not true. True diversification, literally, there are white papers. True diversification is having 4 to 5 uncorrelated strategies. That is the definition of. Yeah, what are you talking about?
Let me tell you the other thing about diversification. It's overrated, and the best investors don't do it. How's that?
Bullshit.
It's not that important to me at all.
Fine, but if you have it's not important to you, doesn't mean that true diversification is not a series of strategies. By definition, that's what it is.
Dude.
So if you choose to be more concentrated and less diversified, then you're welcome to do that. Diversification doesn't change the fact that that's what true diversification is.
That's one of those bad business school lessons that everybody has the wrong idea about. No, overrated. Go ask Warren Buffett. Go ask Carl Icahn. These guys make big time.
First of all, the fact that I own I own NFTs, the fact that I own helium miners, the fact that I have a gold mining, the fact that I do all those things has nothing to do with investing. First of all, those are pennies compared to other strategies that I have in the portfolio that are actually meaningful. And you know what? I'm going to buy the stupid fucking Apple goggles or whatever it's called. And it's not because it's my diversification strategy, investing in augmented reality. I'm going to do it to learn, to help me make better decisions in actual strategies that matter. And that doesn't change. But don't be telling him that he's wrong. He's right.
To each his own. My strategy is figure out what you have an edge in and focus at what you have an edge in. Don't try to do 10 things well. Find out what you're good at. Do a lot of that. That's all. That's what's worked for me. Moving on.
Great. And it's different for everybody. And the fact that Strazza does not want to be diversified doesn't change the fact that true diversification is 4 to 5 strategies. 4 makes the most sense to me.
Most retail investors, what you're saying is just not practical. And I think would be a very big mistake.
Okay, what's practical for retail investors or Strazza is irrelevant when it comes to what is true diversification.
Figure
Right?
out what you're good at. Focus on that. What's next?
Don't listen to him. What I suggest you do is reach out to Chris Kane. Chris Kane
We better short it.
wrote a great white paper. I'm gonna
All right.
I'm gonna reach out to Chris Kane to give it to me, and we'll drop it in the chat or whatever.
Chris Kane's white paper isn't going to change my mind, but sure.
Nobody gives a fuck what you think. I'm talking to the audience who's interested in diversification. And Chris Kane wrote an excellent white paper, and you guys should check it out.
Hey, let's talk about Oracle real fast here. It was the one earnings report that we had this morning, or last night.
Somebody knew. Yeah, I can't wait to talk about this. Let's go.
Yeah, last night. All right, earnings recap. Yeah, there's the case.
Are we just skipping bumpers? We're not.
No, all right. For one, we'll do it. There's the calendar. It is bare because we have officially entered the doldrums of the earnings calendar. So basically, for the next month, pretty much, this is what it'll look like: 1, 2, maybe 3 a week.
You want to hear something funny? This makes Spencer sad, makes Strazza sad, makes me and Sean happy.
No, because it never really ends. Like the next few weeks, we'll have pre-announcements, which we'll talk about, and then the banks are when 3 weeks, 4 weeks.
4 weeks. Yes, JC, this makes me terribly sad. You're absolutely right.
I know, but me and Sean, we look at this and we just can't help but smile.
Dude,
all right.
And all right, let's
Kimmy too, for that matter. By the way, Kimmy too.
Let's also talk about Adobe when we're done with Oracle, because this is really interesting. These stocks at this point, investors already know they're going to beat. And they also know at this point, based on the earnings reactions from earlier this earnings season, that the reaction is going to be positive. So they just ran this one right into earnings. The analysts didn't even wait, came out with a major upgrade yesterday ahead of the report. Stock gapped up higher by like 5 or 6% yesterday, another 5 or 6% today after the report. Investors just know now and have a lot of conviction around the fact that they're going to beat and that the reaction will be positive, and they're front running these trades. You're seeing the same thing with Adobe.
All right, Oracle, let's get that chart up on the screen. Like Strazza said, it was a beat on the top line and on the bottom line. Their cloud revenue up 54% year over year. Cloud infrastructure revenue up 76% year over year as well. And right at this point, there's so much information we have from all their peers we've already reported. So,
like this is such bull market stuff that buyers just aren't even waiting. I love to see this. This is just characteristic of a bull market. As clear as
you love to see it because you've been long.
I mean, look, this is just, we talked about the narrative coming into this earnings season was earnings recession. Okay, so we've come a long way that just this reporting season. This is a great example. Do we have the Adobe chart? Because they're running this one into earnings too. Past few days, I mean, the stock's on a tear.
Here, let's see, and that's also can be very telling, right? A lot of times, not always, but sometimes, company reports earnings and it's a huge beat, and the stock might trade flat or down because it ran up days, weeks before. It already happened. You know what I mean?
And that's something to be careful of. Like Oracle, listen, you got the move after the report. With Adobe, you got like 2 or 3 days. You got this massive gap up. I really want to get the chart up here, Fonz. But like that's something to be mindful of, Spencer, right? Like this could be a sell the news thing for something like Adobe. It wasn't for Oracle, but you do want to be a little bit careful when a stock looks like this into a report. No, Adobe. We continue to see the market continues to tell us, oh, hey, yeah, you're right. Those August highs were really important. And you see it on individual charts time and time again, whether it's price running into the August highs and reversing, or if it's price just gapping right through them. In the case of Adobe, I think we're going to get the chart up soon.
There we go.
We gapped right through those August highs. I mean, just beautiful. Right through it. Butter. So polarity. It works. That's why we pay attention. Listen, this is something you buy on weakness, right, Spencer? If we get like some sort of sell the news move back towards this base breakout level, that's where you want it. You want it against those August highs. The market continues to tell us that is the level, right? So use it as your risk level.
Can we go throw up a chart report? Because I got a good one to continue this conversation.
Yeah, why don't we? No Patty today, though. He had to cancel on us. He doesn't want to hang out with us. Unbelievable. We got
weak sauce.
Yeah, Pat's traveling, but we do have the chart report here, so let's bring it up on the screen and talk about it.
Chart report.
By the way, we got feedback from the chat that the bumpers are just a tad too loud, so we'll be making them just a little quieter.
Usually, if they're saying JC's too loud, that's the feedback we usually get. Why is JC yelling at us?
we turn your mic down. I like the bumpers loud because they pump me up. They just get me ready. I'm back here dancing in between.
All right,
pump you up in the morning. I like it. Yo, throw up the bar chart one from Tesla. Strazza, weren't you talking about this like in our meeting yesterday or something?
I don't know about you, man, but I've been drinking a lot more coffee since we started doing this morning show.
I've been drinking about the same.
Yeah?
Yeah.
You drink a lot of coffee, but Ian wins most coffee at
I stop at like 11. I stop drinking coffee at 11, so I crush it until like 11, 10:30, 11, maybe even earlier than that, and then I can't drink it after that. I got issues.
I try to stay away from the afternoon. Yeah, this one's great. 12 consecutive days. Unbelievable. I wish Pat was here so I could pick this bone with him, because what was wrong with my chart? I thought mine was pretty good too.
Oh, you shared the same chart?
Yeah, only
I thought I heard you talking about this. By the way, it's up again today, another 2%.
Listen,
that would make it what? 13 consecutive days, longest win streak in company history. Not that it has that long a history, but still.
All right, so talk to me. Is this chart porn? This indicator, like what? How do we weigh this? This indicator, what does it mean? Anything at all to you, or is it just kind of?
I'll tell you what it means to me. To me, it's just further reiterates that relentless bid and growth that we've seen, despite any moves in rates that would suggest otherwise, and that continues to be impressive. You can make the same argument on Nvidia. It's not just Tesla that is this relentless bid. Meta, right? I mean, you're seeing it in a lot of areas. This is just another example. In this case, it's 12 or 13 days, but you can make a similar interesting point about a lot of those others in the space. So that's what it means to me.
It speaks to the character of the market, the environment that we're in, right? You don't want to look at it and use it as a buy signal or anything like that, but it's just a reminder. This is bull market stuff. It's just another one of those things. It's cool to go back and say, hey, best win streak ever. This stock has been going up consistently for 13 years now. But
let's say hypothetically it was the third best winning streak or the fourth best winning streak. Like, you can change the fact that it's just ripping with some of its, cousins and brothers and sisters also ripping, all of them kind of doing the same. That's more important than whether it's the longest or the second longest.
I think this chart is just interesting, knowing what happened to the stock in 2020 and 2021, where it seemed like it was going up every single day for like months on end. It just went straight parabolic, and yet this is the longest streak. I think that's the point.
That's right. It's surprising that it's now and not at some point in the past. Throw up. I'm just going to drop this into chart one to provide a little bit of that context. Throw up chart one right now.
I had a chart as well from the chart report that I wanted to highlight. Yeah.
So there you have it. That's going to be going on.
That was your chart that didn't make the chart report?
Unbelievable, right?
That is some bullshit.
He's a hater. Yours
is definitely better.
I know. I don't need to say that. Yeah. Thank you. But look, this is big. This is by far the biggest streak. The last one happened kind of near the peak in 21. But there were some other like big spikes that occurred at the beginning of uptrends 2020, 2019, even back in 2013. So interesting stuff. Tesla is in the same conversation as Meta and Nvidia with these mega cap tech stocks that have just already registered ridiculous gains on a year-to-date basis.
Remember all the short interest in these names coming into the year, man? You and I were doing all these bubble charts, finding the ones with the highest short interest. Remember that?
We're going to do like a bubble chart.
Just yesterday.
We're going to have more bubble charts in our lives soon. We're going to do one to illustrate this wild rotation we've been seeing.
The world, I'm telling you guys, I feel like nobody listens to me. The world needs more bubble charts. I don't understand. Like, why is this concept so difficult for people to understand? The world wants more bubble charts. So just give people what they want.
Yeah. They need more bubble charts.
Give
Go
the people what they want. I liked this chart from Katie Grayfield from Bloomberg. Record weekly inflows into the RSP, the equal weight S&P 500 fund last week. $1.1 billion.
I never understood.
Tell me what that means.
I don't know what it means. What does it mean?
What does it mean? So I look at flows as like a sentiment indicator thing, right? Because it's not obviously inflows aren't necessarily don't necessarily mean people are net buyers, and outflows don't mean that they're net sellers, like on an individual basis. But to me, like if you see like a lot of inflows in a given fund for a given period, or a lot of outflows, it's a sentiment thing. It means some allocators somewhere are accumulating, buying or selling this strategy or this theme. And so I just look at it for sentiment. So I just thought it was interesting. This does not mean...
One day I want to come to the realization that I understand the value in fund flow. Like I want to wake up one day and be like, oh, wow, this is really helpful. I haven't gotten there.
This does not mean RSP is going to go up and you should buy it. It just means that people are interested in it. That's what that means.
You know how Van Gundy, when he's announcing basketball, he's always ripping on the refs, and he's like, I don't understand this rule. That's like me with the fund flows. I'm like, I don't understand. Shout out Jeff Van Gundy, right?
You're taking my recess talking point.
Oh, sorry, shit. I didn't know that's what you were going to talk about. All right.
You want to do it now, or you want to save it?
Yeah, you know what?
It's a little early for recess. Settle down.
Wait. Sam has a good interpretation of what that chart means. It just means all the FinTwit folks discovered RSP.
That's pretty funny. I feel like everyone's an equally weighted index expert now. All of a sudden,
not me. I still don't get it. All right.
Talked about.
What do you mean? We explained it to you, and you were like, "Okay, that makes sense." No,
yeah.
We're not rehashing this. Everybody or nobody talked about these equal weight Invesco ETFs. This has been great information for us for a long time now. Now all of a sudden getting a lot of buzz. They got these new sexy tickers to make them more identifiable and easier to find. Like they know what they're doing. This is great marketing for these Invesco funds.
Shout out Invesco. The other thing is, to what we were talking about before, Spencer, months ago was asking us about these things. Just to be clear, these equally weighted ETFs, like we're never buying these. I've never bought one ever. I have no interest in ever buying one. Yeah. It's really just for information to understand if the cap weighted indexes are leading or if it's more the equally weighted names. And it's not that one index is better than the other. It's just different information and putting it together. So we look at both. It's sort of part of that conversation of, when you look at other countries around the world and you look at their stock markets, do you price it in local currency or do you price it in US dollars? The answer is we do both. So it's more of a weight of the evidence, and it's information we're getting from the equally weighted indexes that we find really helpful.
So I would argue that one is better than the other, and they're each better than one another at different things. So like what it comes down to is, what is your objective with these funds? Are you looking for an investment vehicle or information? If you're looking for an investment vehicle, it's always the cap weighted. Always. We'll talk about why. If you're looking for information, it's always equal weight. So my question to you would be, somebody says, oh, these ETFs suck. Well, what are you trying to use it for? Right? Because they each kind of serve a really nice purpose for us. And if you're looking to invest, you always buy the cap weighted one. And it's really simple. It's just math. It's the best momentum strategy in the world. The cap weighted index. All they're doing is every time they rebalance, they're buying more of the best stocks. They're buying more of the leaders. It's exactly what we do, right? Just in a different way. It's a little bit more defined.
As opposed to the equally weighted, where what you're doing is you're watering your weeds and you're cutting your flowers.
They're doing the opposite. They're literally selling the best ones to buy more of the worst ones. So you would literally never want to use that as an investment vehicle. When people look and they say, oh my God, the equal weight is underperforming. It's like, yeah, good. It should be.
The equally weight underperforming, all that means is that tech and growth is outperforming and is a leading sector. It's not good breath or bad breath. It's a sector rotation thing, because the equally weighted S&P 500 led the entire back half of last year. Why?
Yeah.
Because the growth stocks and the tech stocks were underperforming. It was industrials, it was the other areas that were leading, which is why the cap weighted was being dragged down by those big growth stocks, was underperforming. What happened this year? Those growth stocks are outperforming. So guess what? The equally weighted index is underperforming. It's perfectly normal. Like, it's not that big of a deal.
I thought that the chart you brought on with Perlman and Linzen 2 weeks ago on Trends with Friends is by far the best visual representation of that argument. And it like
which chart is that? Which chart is that?
You did the growth versus value overlaid with cap weighted versus equal weight. And what you were basically trying to say was it's the same thing.
Throw it up, Bond. See if you find that. Throw it up.
Just to play devil's advocate, the argument, and I don't believe this, but the argument for the equal weight is that leaders don't continue to lead. There are new leaders all the time. There's a rotation of leaders.
But we know it's not true. Leaders tend to keep leading, actually. We have the math.
10 years.
Yeah.
Not forever is the point, right? So, right. Right.
It's dumb.
It is so hard to bet against big tech. I mean, like, it's just a tough game to play. You got to give these.
It's not hard if interest rates are rising.
Dude, I mean, interest rates ripped, and a lot of these stocks are still back at all-time highs.
Rates ripped.
Rates rose the fastest pace in history.
All right, for like a day or two.
No, for like a year.
No. What? Right. And how did tech do in that environment?
They got hit, but my point is they're back.
Okay, fine, but rates peaked in October.
Guys, again, interest rates are still up there.
Okay, but rates peaked in October.
Dude, here's what happened. They discounted these stocks way too hard in 21 and 22.
And the short interest was super high. All of those things, yes. But
these companies got
rates peaked in October.
But they haven't come off much. And look at what these tech stocks.
But they're not going up. That seems to be enough. But they're not going up.
Dude, if rates roll here, look out. It's back to big cap tech. That's really where you want to be. If and when we get evidence that that's no longer the trade, fine. I think there's going to be great opportunities in small caps and industrials and these other areas. But tech continues to tell us day in and day out that they're not stopping anytime soon. The way these stocks are correcting is just so bullish. It's wild.
Like Kimmy shorting Adobe.
Oh right yeah, now. I was gonna point it out to you. Yeah, she's shorting. Speaking of Adobe,
this is just a good example. This is a great example of what Kimmy does. She's looking for that mean reversion, right? She's looking at Bollinger Bands. When these stocks are in their upper end of their bands, momentum is overbought on RSI, MACD, stochastics. You're getting these overbought readings. No matter how strong the stock or the sector looks like, this is just a trade that could last anywhere from 5 minutes to an hour to a day.
Oh man,
right?
she's already out. She just covered. She covered in like seconds.
Perfect example, right? So classic.
Yep. All right. So join Kimmy's room. Email number on the screen there. I just want to mention before I forget that screen I was showing before was from the chart report. If you don't get that, I highly recommend it. It's a free daily note that compiles the best charts and wisdom from around the world of finance on Twitter. Use the QR code on the screen or click the link in the description of this video right where it says the chart report to subscribe to the chart report today and get today's issue. Okay, we have our final guest here. He's been waiting very patiently, I will add. Ian Culley, head of FICC at All Star Charts. Ian, we all ready? I think so. Let's get Ian on the show.
Good morning, guys.
In one of those pictures in the bumper, Ian looks like Blippy. You guys know Blippy? Strazza doesn't know Blippy. Ian knows Blippy
either.
You don't know Blippy? Good. You don't want to know Blippy.
So it's not a good thing.
It's just a really annoying, like, little kid show, you know, that my daughter watches. So he's like just this creepy guy who goes to parks and stuff like that and does stupid things. It's pretty creepy, but she loves it. All kids love it. Blippy.
Great.
Anyway, give me the update on Fed funds futures. Let's throw up Alfonso. Freaking Chart Ninja just did a before and after view for us of Fed funds futures. Before the CPI print, after the CPI print, it looks like absolutely no go tomorrow. Right now, we went from what 79
What's it down to now.
It's around 93% right now. It went as high as 94% earlier in the hour.
93. You said what's it at now?
It's at 93.
Yeah. So
we're pause.
And then if you look through to July, like John was saying, still about what 58%? What is it right now? 58.
Right now it's about 60% for a 25 basis point hike.
Still giving us a hike next meeting. So
Which is what? End of July?
July meeting. They're pricing in a hike just barely. And then that hike gets undone by November, I believe.
What's the percentage on the hike? July 26th. What's the percentage of the hike?
58, or Ian, you might have.
I got 60.
From
60 and a half.
From what? From what?
Go back to the before. It was still 58 before, it looks like.
Yeah, it was still in the 50s. It hasn't changed too much.
Okay.
All right.
So July is staying firm. Like Netto said, the report was kind of mixed a little bit for everybody. But it seems as though what the report did solidify was no hike tomorrow.
You think Netto and Ian are going to be besties now?
Listen, John, John just brings a really interesting perspective. He's really fun to talk to. It's different from the conversations that we're used to having, right? So that's refreshing for me.
Yeah, for sure. Ian, I can't help it but ask, when we've seen this relentless strength and growth, we just talked about Tesla up 13 days in a row, NVIDIA breaking out of bases. I mean, just tech growth, semiconductors breaking out of flags. NASDAQ continues to, its dominance. I mean, all of that points to lower rates, no?
It does. At the same time, I think what it really, it reveals is that they just need rates to stop rising, right? So, rates don't have to necessarily roll over. They just need to stop ripping higher. Like Strazza just mentioned a few minutes ago, rates ripped last year at an unprecedented rate, and tech got crushed. But rates peaked back in October. And since then, it's just been chopping sideways, and big tech has really enjoyed that action. So maybe they don't have to roll over. Maybe they just chop sideways here.
Maybe they keep going sideways.
Yeah.
Year. Everybody's trying to pick up or down.
That Caterpillar up another 2.25%. Shout out to Shawnee, baby. One for the good guy, Sean.
Throw up the Boeing. Sean's saying he already got stopped out of Shopify. I'm just going to let it go. And we'll discuss how the different trade management works out. I think that'll be a really fun topic. Next week.
It's a really interesting point that you bring that up, Strazza, because Sean does a really good job of, when you own calls, you already have built-in risk management because they can just go to zero. You're a limited partner, right? Like you can't lose more than what you bought them for, which is great. So you're already managing risk. Sean takes it to another level, finds a level of support, and if he gets shaken out of that, all bets are off. So you salvage some, right? I tend to be more in the Strazza camp is what I found myself, which, by the way, Sean, you got stopped at, not to, dig deeper, but you got stopped out of that meta, and I held in, and that worked out very, very well. So it's a good example. So there's no right or wrong way to do it. I appreciate Sean's risk management. I really do. But I'm with Strazza on this one.
He's great at it. And like the thinking was like, this was a thoughtful decision. It's why we picked like the really in the money calls, because we didn't want price to really move on us too quickly on downside. So Sean literally said yesterday when he was getting into it, because of the contracts that we chose, I don't have to take a zero as my loss. I will be able to manage it in a way where, I can get out and it still has some sort of value. I don't know what that value was. I don't think he's telling us in the chat, but we'll talk more about it next week. So Ian, do you want to talk about how you're YOLOing uranium?
I'm looking up Blippi right now. I'm sorry, guys.
Can we get some?
He does look like Blippi.
I got a Boeing chart. We did get a from the chat question about Boeing. Let's just do this quick. Boeing is somewhere in here. I dropped it in.
For the record, he doesn't look anything like Blippi. It's just that in one of the pictures in the bumper, he does. But I know Ian personally. He looks nothing at all like Blippi, actually. It's just that picture.
Way too many children's cartoons. I need
to get a hat.
I think I am losing my goddamn mind. I'm singing like, I'm singing the Peppa Pig songs, like whistling them in the hallway and shit. Like it's not healthy.
I'm into Peppa Pig. Baby Shark's great.
Baby Shark's another one. I mean, doesn't get more annoying than the stupid Baby Shark, but the kids love it, man.
Oh, Boeing, look, industrials, broadening of participation by the big boys. The big boys are working. Boeing above 215. Lots of like here. Lots of like.
Yo, recess. I got things going on. So I want to hear Strazza's take.
All right, I guess we're going to recess now.
hard pivot. Give props where props is due. Right? Denver Nuggets. Shout out to the city of Denver. I love Colorado. It's my third favorite state in the union. Big fan of Denver and all things Colorado. So God bless you guys. What can you say? Dominant. Jokic, which is hilarious. He in the interview afterwards, like he's all excited because he gets to go back home to Serbia, and he's like, they're like, oh, you have to stay for the parade in 3 days. He's like, are you fucking kidding me? I can't go home. I have to stay for. I thought that was pretty funny. So shout out Denver.
Yeah, he's different. He's very humble. But listen, really good team. It was a good series. He should have pulled it out last night. But what I do have to say is, just from watching all this basketball lately, I am convinced Jeff Van Gundy is the best announcer in sports. Maybe there were better ones back in the day, but in my lifetime, this guy is so honest. I don't know how he still has a job. Where is this in the football announcing booth? Like, God forbid they ever disagree with a call, Aikman or Buck. Van Gundy's over here, like, talking about, like, every call. He's like, nah, I wouldn't have called that. I wouldn't have done that. I wouldn't have sat him. It's really, like, refreshing to hear him kind of, and you can see the game through his lens. And also I'm biased because Jeff Van Gundy, greatest coach in Knicks history. So a lot to like with JVG.
Remember when he was grabbing Zoe's leg, right? It was hair all over the place.
Yeah. He used to get in the mix. Well, I told you yesterday, man, Christian Brown, he's such an obnoxious player. He reminds me of PJ Brown. He just harasses the other team. I think he's going to
be good. I think he's got a lot of potential.
I'm not saying he's not going to be good. I'm just saying, like, people are going to hate him.
He's one of those guys that, is just going to be annoying. Goran Dragic was one of those players that was so annoying to play against. And then he got on our team. I'm like, I freaking love this guy.
All right, I got another one. Did you see this crap with Binance?
Which crap in particular are you?
Dude, this is just bad business. So I get a alert on my phone yesterday from Binance. I click on it, and it's like an emergency. It says emergency volatility. They said, exercise increased caution. Don't let anyone mislead you into sharing your account information, clicking on a suspicious link or attachment, or sending your crypto to an external wallet address. Scammers and bad actors rely on uncertainty to target you and your funds. Your funds are always safe and secure on Binance.us. Dude, that just smells so bad of one of those everything's fine right before the end type of messages. Like, we've seen them a million times. I think we're going to look back at this one and say the same thing. They're basically fear-mongering people from withdrawing their crypto. Like, it's not safe to withdraw your crypto. It might get stolen. Like, dude, just stop. Like, that's bad business for them. It's embarrassing. Come on, do better. No?
Can you not get your crypto off into
I also haven't tried too hard yet. I'm not really too worried about it. It's not like the most amount that I have there. It's like JC said, a bunch of fractional shitcoin positions. But no,
legacy shitcoins. Legacy shitcoins.
It's sizable enough that I do care about it and hope to get it. What's really annoying for me is I came on here like Tuesday of last week and I said, take your money off Binance. I'm taking my money off Binance. And I waited like 2 days and got busy. And now I can't get my money off Binance. But I'll keep you guys updated. I don't imagine I'm going to lose it, but it is a pain in the ass right now.
Yeah.
I got more.
What you got?
How about these emojis?
What emojis?
Yeah.
So I'm really bothered, okay, because I like to use the chart emojis on Twitter. And have you seen the uptrend is red and the downtrend is blue?
Blue. Doesn't make any sense.
So I pushed back on this. I threw something out there, and the emoji people came after me like I'm the idiot, okay? I'm serious. So this is a thing, and here's the reason for it. Emojis, we've done the research now. They originated in Japan. It's a Japanese thing.
Is it?
Yeah, and they said in Japan, it is normal to look at charts that are going higher or uptrends in red. They look at their charts in red.
No.
So I thought to myself, first of all, I don't care if that's what Japan does because the rest of the world, green is up, red is down. And I thought, maybe, does this have something to do with the fact that stocks haven't gone up in Japan for 35 years? So of course, all their charts are red. I don't know, but somebody out here has to back me up. We got to get a green uptrend and a red downtrend, because this is terrible. Backwards.
Talk about first world problems, Ian. You know?
I know. I love
This
it.
is as first world a problem as it gets. I don't like the color of my Japanese emojis. This is bullshit. We should riot.
Yeah, let's rally, guys.
I think Steve is onto something. Steve is onto something. Up is down there, right?
This will be the first question I ask when we touch ground in Japan. I'll be asking everybody.
I encourage you to ask I encourage you to ask which way to the fish market? Which way to the fish market? That's the question you need to be asking yourself, my friend.
Well, I'll be asking that too. Gonna eat good. You guys got anything for recess, or should I just keep rambling?
I got nothing.
I'm going to the beach. I'm out.
Nice.
JC's at the Jersey Shore. I don't want to take any more time away from the beach for him, so I'll wrap it up here. That's our show. Thank you to our guests, Kimmy Sokoloff, John Netto, John Gagliardi, and Ian Culley. Thanks for watching. Hey, check out our free research. If you go to the YouTube video that you're watching this on and scroll down to the description, I have links in there for free research that we're doing every single day. Click on those links. Get our free stuff. Thanks for watching on YouTube. Thanks for all the comments. Thanks for the chats, the questions. If you want to give us a like, hit the thumbs up. I would appreciate that. I know these guys would as well. Stay tuned on the channel later today. We have CRL chart request live at 1 o'clock. Are you guys doing part of the price action today? Do you know?
We are not.
We're not.
Good
to know. All right, but we are doing CRL.
Aren't you the calendar guy? Check your calendar, Spencer.
My calendar. All right.
Calendar guy over here.
All right. Check the calendar, Spencer. That'll be a wrap for us. Everyone have a great rest of your day. If you're at the beach, enjoy the beach. If you're trading, good luck. Happy trading.
What if you're doing both? What if you're at the beach and you're trading?
I hope you have good Wi-Fi.
Run it. I can't take no loss. I don't even know what it costs. I hit the ground, then I go off. Yeah, hit the ground.